5 things you need to know before starting your limited company. Hi, I'm Peter Jarman, Managing Partner of PJCO, Chartered Certified Accountants, based near Brighton on the South Coast. I have over 25 years experience helping small and micro business owners with their accounting, tax planning and compliance. As you have clicked on this video, I imagine you already have your own limited company or are about to start operating through a limited company. A limited company is a type of business structure that has been incorporated at Companies House as a separate legal person. It is separate from its owners, it can enter into contracts in its own name, and it's responsible for its own finances and liabilities. Number 1, what it means when you form a limited company. When you go off to Companies House and form a limited company, what you have created is a separate person in law. You are the director of the company, which means you work for the company and are responsible for that company. And you're also the shareholder of the company, which means you own the company. When you form this company, you will receive a birth certificate, a certificate of incorporation. And with that certificate, you're able to go off to a bank and open a bank account in the company's name. Number 2, you need to understand the difference between a director and a shareholder. A director is simply an employee of the company. You work for the limited company. On top of that, you have some extra responsibilities as a director. You're responsible to make sure that the company complies with all the laws and regulations. What is a shareholder? As a shareholder, you are an owner of the company. You are waiting for the directors to run the company successfully and produce a profit. And when they produce a profit, as a shareholder, you will receive that profit by way of a dividend. Shareholders do not work for the company. They are simply owners of the company. It's very important you understand the difference between your role as a director and your role as a shareholder. Director working for the company, shareholder owning the company. So that brings me on to my 3rd point. Why choose a limited company? Well, certainly some people say it looks better, you look more professional. That can be a reason. The main reason you would probably choose a limited company is because you want to separate your personal assets from your business assets, also known as limited liability. Let me explain. If you happen to own a house, a car, a TV, and various assets, and then you decide you want to start trading, you might not want to risk your house, your car, or your TV. But if you don't operate as a limited company, so if you decide to operate as a sole trader, when you contract with customers, those customers are contracting with you personally. That means that if something goes wrong, those customers will sue you personally. And if they're successful in suing you, they would be able to go after any of your assets, your personal assets or your business assets. So in that case, if you operate as a sole trader, it's perfectly possible, if you have a claim against you, that you could lose your home, your car, your TV or your investments. Now, most business owners don't consider that a very sensible route to take. So they decide to separate their business assets from their personal assets, and they do that by forming a limited company. That limited company then contracts with your customers, and that limited company gets paid from your customers. Number 4, now I come to tax. Operating through a limited company can give you a tax advantage, especially if your company is earning more than you need to spend personally. And as individuals, we have to pay taxes up to 45% on our income, plus national insurance. Employees' national insurance at 12%, employers' national insurance at 13.8%. So as individuals, the tax liability can accelerate way above 50% for any individual in the UK. As of today, October 2020, the maximum rate of tax is 19%. So no matter how big your profit is, whether it's £1 or £1 million, the maximum rate of tax you will pay on that profit while it sits in your company is 19%. That's the advantage of a company. You're able to earn as much as you can and only pay 19% tax. Now, once you take that money from the company where it suffered 19% tax and you want to take it back, you want to give it to yourself as income, that's when you have to pay all of those personal taxes that everybody else in the UK has to pay. So you've got to see your company as a separate little entity that has a special tax regime at 19%. Keeping the money in the company's bank account, keeping the money inside the company environment means you keep the tax liability to 19%. But remember, when you take that money out of the company and receive it personally, then you're going to have to pay the tax rates that everybody else has to pay. That's the secret of a company's tax advantage. Which brings me on to my fifth and final point. There are only 4 ways that you can take money out of a company without creating yourself a significant tax liability. The 4 ways that you can take that money out of the company into your own hands are as follows. Number 1, as a director, you're an employee of the company and you're entitled to take a wage from the company. Now, when you take a wage, that wage is subject to PAYE. And PAYE is a real-time information system with HMRC. So if you're going to take a wage from the company, there's a need to calculate the gross pay, deduct tax and national insurance from that pay, tell HMRC on the day that you do this under the real-time information system, and then you're able to draw the net pay from the company's bank account and put it into your own personal bank account. It's the first way that you can take money from the company as a director, as a wage. The second way that you're able to take money from the company's bank account and put it into your bank account simply is as a reimbursement of expenses. If, for example, you use your own car for company purposes, you're able to claim 45p per business mile for that business mileage. If you happen to buy something for the company personally, you're able to claim that back as an expense claim. So if you happen to buy some stamps for the company, you could claim back the cost of those stamps. The way this works is you will produce an expense claim for, let's say, a month. That expense claim will list out the mileage, payments you've paid for stamps, stationery, anything else you've bought on behalf of the company. And then you'll submit that expense claim to the company, and the company will reimburse you that expense claim, that exact amount. Now that's the second way you can take money out of the company. You can be reimbursed for expenses you've incurred on behalf of the company. The third way that you can take money out of the company is not as a director, as an employee. The first 2 ways were as a director, wages and reimbursed expenses. The third way is as a shareholder of the company. You're entitled to a share of the profits of the company. Now, when a dividend is paid to you as a shareholder, there is a need for a certain legal process to happen. The directors must review the financial position of the company, must decide that they can afford to pay the shareholders a dividend, and then they must put in place the paperwork to pay that dividend. Now, once all those things are done, you're able to draw a dividend from the company's bank account into your bank account as a shareholder. That's the third way that you can take money out of that company's bank account. And finally, the fourth way, and the only other way you can take money out of the company's bank account without causing yourself a tax problem with HMRC, is if you've lent the company money in the first place. So you've given the company a loan to get started, you're able to draw back that loan, but you're not able to draw back any more than that loan. So if you've lent the company £10,000 to get business up and running, you're able to draw back that loan tax-free. But once you've drawn back the £10,000, that's it, you've had it all. But that first loan that you've given, you're able to take that back tax-free. Now, they're the only 4 ways you can take money out of the company. So it's very important when you run your company, you take money out one of those 4 ways. Here at PJCO, we're able to help you with that. We're able to set up systems that allow you to pay your dividends and monitor and repay your debtor's loan. We use QuickBooks Online, an accounting system, to do all of that. Thank you for watching, and I hope you found this video useful. If you've enjoyed this video, Please like and subscribe. Please leave comments below and we will try to help you with further information in the future. We are a firm of expert accountants specialising in small and micro businesses. If you would like to discuss further about starting a limited company, please feel free to contact us for a free discovery call with myself or a member of our team. I will leave the contact details below. Goodbye.